So here we are at the last chapter. That's exciting, right? The last new stuff um, this week, and then reviewing for the final, and then taking the final and being done. That's pretty good. So this information, this chapter, is sort of a bridge, a crossover between financial accounting and managerial accounting, which is what the second accounting course is. And this is where we start to, do you remember all throughout the chapter or all throughout the semester, in every chapter, there was a few of these financial ratios, is what they were called. At the end of each lesson, there'd be like, how to find the current ratio or the quick ratio or the earnings per share or all those. So they all kind of come together in this chapter um, as we start to look at analysis. And so whenever like I will work with a business, often I'll kind of start with, well, if they have good financial statements, we'll start with these analyses. If they don't have good financial statements, then we've got to get their numbers in order so that we actually have good data to do this analysis. So there's a couple ways we go about trying to analyze a business. In one setting, we kind of compare them against themselves in a previous time period. In other words, how did you do this year compared to last year or compared to 3 years ago or 4 years ago or whatever? And we start to try to see a trend. That's called horizontal analysis. And horizontal, right, just means like this way, like across the horizon. And so all it really means is you'll see like a balance sheet, and then it's just compared across years. And so this one just has 2 years, 2025 and 2026, or 2015 and 2016. I'll let you decide. All right. Has 2 years. And then there's another two columns over here. One shows the difference between the two, the increase or decrease, and the percent. So this is the Lincoln Company. We're looking at a comparative balance sheet that shows the balances at the end of 2 years side by side, and then the amount of increase or decrease both as a dollar amount and as a percentage. And that's what horizontal analysis is. So let's look at this, guys. Their current assets are up $17,000. Their long-term investments are down 82.5. Their property, plant, and equipment are down 25.5. Their intangible assets, if you remember, that's things like copyrights and patents, those are unchanged. So overall, this company has $91,000 less assets, or 7.4% less assets than it did the previous year. So without any other context, would you say having less assets is good or bad? What are assets? What? Their assets are good? Okay. What are assets definitionally? Things you own. So if you own less stuff a year later, is that typically good or bad? Usually bad, right? There could be some context that could help explain it, and it wouldn't be as bad as it seems. But generally speaking, having less stuff, less cash, less equipment, less land, less buildings, that's not typically good. So our very first look is like, okay, our assets are down by 7.4%. And so if you're trying to do an analysis, your first thought is like, what does that mean? Or what would lead to that? Especially because their current assets, which you remember, those are like cash and all the things that turn into cash, they're up. So they've been selling off long-term investments and selling off property, plant, and equipment. Again, might there be a good reason to? Like we've had this stuff sitting here forever. We're never going to use it. Let's sell it off and raise some cash. Sure. Like that might be a healthy thing to do. Um, anyway, but so we're starting to try to see this more holistically. Remember, like all through the course, I'm like, quit trying to see things holistically and just look at this one entry and make this decision about this entry. Now, finally, we get to where we're looking at the whole picture because we're doing an analysis of the health of a company. So their assets are down, their debts, They have 33,000 less in current liabilities and 100,000 less in total in long-term liabilities. So 133,000 less in total liabilities. Generally speaking, fewer debts is a good thing. Does that make sense? Paying off your debts is generally a positive thing. So you're like, okay, they've reduced their assets, but they've also paid down some of their debt. So we've got a mixed thing here. Their stock, preferred stock is unchanged. Common stock is unchanged, meaning they haven't issued any more stock. The retained earnings is up 30.5%. So, and their total stockholders' equity is up by 5.3%. So here we have a company who is reducing their assets, but also reducing their liabilities. And in fact, reducing their liabilities quite a bit more than they reduced their assets as a percentage and as a dollar amount. Okay. And their overall stockholders' equity is going up. So when you're doing this sort of analysis in real life, working with a real business, okay, this doesn't tell me the whole story. Instead, what I've always said is when I do this horizontal analysis, it gives me questions to ask to understand how well management understands what's happening in their own business, right? So I would ask something like, so I noticed you sold off 82,005 or you have 82,500 less in investments. What's that about? And they could usually tell you. And then is this a healthy thing? Like they're just trimming out investments that they don't need? Your property, plant, and equipment went down. What's that about? I noticed that you used some of the money there to pay off debt. So this to me says they're probably doing okay. In fact, their retained earnings is growing, which means they're making a profit. Okay. So that's a horizontal analysis of a balance sheet. They also have horizontal analysis of income statements. So again, comparing 2 years like that, this one you can see their sales went up pretty big, 298,000 or 24.8%. Their cost of goods sold went up even a little bit more than their sales as a percentage. So their gross profit's up 19%. We can look at all their different expenses, and then down at the end, we see their net income is 19% greater than it was the previous year. Overall, we'd say that's a positive thing, right? The only thing I would be questioning them about is usually our cost of goods sold is tied to our revenue. The more we sell, the more our cost of goods sold. So if the cost of goods sold is going up at a higher rate than the revenue, you might ask why. Do you know why that's happening? Some business owners would be like, I know exactly why, because our suppliers increase their prices or whatever. Others would be like, I have no idea. So we can look at it. So all a horizontal analysis is the comparison of two financial statements across a time period. Often it's just 1 year like this. Sometimes you'll see 3 years or 4 years. Okay. And the intent is to get a sense of how things are moving or changing. Sometimes you'll even see a 5 year one, and then it'll have like a trend line going up or down or whatever. All right, so let's look at one in our homework here. So this is the Macklin Incorporated Company, 2022. It's like they had a significant increase in net income. John Mayer is the president, but he hasn't been popular in a while. So here's his comparative income statement. And then they're just going to ask us for an increase or a decrease amount and percent. So we could just do this with our calculators, right? We could take 910,000 minus 700,000, and that would give us a $210,000 increase. But I'm lazy, so I'm gonna use Excel. I don't know. It might be easier to do it with a calculator because with Excel, I've got to punch it in for everything, right? But with a calculator, you also have to punch it in for everything. So I'm just going to put those are negatives. Oops. All right. If I want to, I can label them too, but I'm just trying to be quick and make it easy. So to find the amount of increase or decrease, right? So since this is the year 2022 and this is 2021, we're going to subtract the older year from the newer year. So I'm just going to say this column is 2022's amount minus 2021's amount. Then, if you're not familiar with Excel, once I've put that little formula in, I can just see how my cursor changes from this little fat plus sign to a little skinny plus sign. When I roll over that nail, I can grab that, drag it down, and it will just fill that same formula all the way down for me. Again, most of you have probably done that with Excel before, but it's a really handy tool. All right. So now I have all my answers here, right? 460 minus, so selling expenses. I don't know if it's going to like these as negatives. I don't like them as negatives. I also don't like putting expenses as negatives. I think it's confusing. All right, let's see how it goes. Yeah, see, it doesn't like those as negatives. And the reason they're negatives is because we're putting these in as negatives like they have them here. So it just wants them all as positive amounts because that's actually the amount because those expenses actually increased. But because they're showing them as negatives, it looks like they decreased. Does that make sense? So that's what's stupid about them showing as negatives. Okay, it doesn't like that one either. Oh, that's because I just put that in wrong. Put an extra zero. All right, so there we go. Excel made that job a lot easier, except for this issue with the negatives. And that's because Cengage is dumb, which I know that you guys are already aware of. Daddy. There's no children allowed at the school, only young adults. All right. So now that we have the difference here, to find the percentage, all we do is we take the amount of the difference divided by the amount of the older year, right? That tells us how much is that changes as a percentage of the older year. And again, once I put that formula in once, I can drag it down and I can even tell Excel, please express this as a decimal. What does it want? How many decimal or one decimal place? So I'm going to tell Excel, give me a 1 decimal. All right, so now we can look at these numbers. Once we get them all entered, we can ask ourselves, what do they actually mean, right? So our sales went up by 30%, and our cost of goods sold only went up by 26%. That's nice. So actually, as our sales grew, our cost of goods sold didn't grow quite as fast, giving us an increase in gross profit. But then we can see all of our expenses went up too. And there's always this hope, right, that as you grow your sales, even though you know your cost of goods sold will go up, but maybe your fixed expenses will stay truly fixed and they won't go up as much. And so you can see our selling expenses went up, administrative expenses went up, so our total operating expenses, but still sales are up by 30% and operating expenses are only up by 19%. That's a positive thing. It means even though we're selling 30% more, our costs only went by 19%. So we're going to be making more profit. So our operating income, which is our sales minus our operating expenses, is up 53%. That's a positive thing. We have other revenue. That's up 50%. I don't know if that's good or bad, really. Other revenue just means, oh, sorry, up 30%. It just means money we've made by selling things that we don't usually sell, like it could be a piece of land or whatever. So I don't know. See our income before income taxes. We see our income taxes are up 30%. And overall, we've made 53% more net income or profit this year. So this is very positive. And so if it were a real life situation, I would be sitting down with that business owner and saying, what did you do differently this year? And like trying to understand what improvements, how these improvements came about so that we can keep them going, right? Or maybe even continue with more. So the value of horizontal analysis is it lets us compare ourselves to the previous period or even other more previous periods and say, well, what was I doing well? What was I not doing well? And what can I do to improve even more, or at least continue this good situation? All right. So net income has blank. It has increased. Net sales have increased. However, cost of goods sold, selling and administrative expenses have well, no, they've increased as well. Increased at a slower rate, causing strong earnings growth. So sometimes you'll hear that on the news, right? Like this company had strong earnings growth for the year. That just means that their profits are higher this year than they were previously without much analysis as to why. That's where you really got to get down to, right? And say, well, what's causing this and how do we keep it going? All right. So there's our first one. All right, so if we have a horizontal analysis, which remembers means looking across and looking year by year by year, we do another type of analysis called a vertical analysis. Vertical analysis means we're comparing things up and down the column. And so what we do with a vertical analysis is we take the highest number on the report. So on a balance sheet, that is always total assets. Okay. That's going to be the highest number because we know that total assets equals total liabilities plus equity. So those will be our two biggest numbers on the balance sheet. And then we just divide everything else by that number. So we can see it expressed as a percentage of that. So we could we'll start with current assets. Current assets divided by total assets. Our current assets make up 48.3% of all of our assets. Okay. Our long-term investments are 8.3%. Yeah, I'm looking at 2016 here. Property, plant, and equipment make up 39%, and intangible assets are 4.4%. Our liabilities, again, we're taking this amount divided by the total of liabilities and stockholders' equity, which is the same as our total of assets. And we're seeing that our debts make up 18.4%, current debts, long-term debts are 8.8%, stock 13.2%, common stock 43.9%, retained earnings 15.7%. So in a horizontal analysis, a vertical analysis, all we're doing is dividing every single row or line item by the largest number on there. And so for a balance sheet, that's always the total asset amount. That's going to be the largest number on the balance sheet. So we can see them all as a percentage. Here you can see they've done sort of a vertical and horizontal analysis. At least they just have 2 years worth next to each other, but you can see they didn't subtract and show you all the difference between the 2 years. So here we can see that our current assets went from 43% in 2015 up to 48% of our total assets. That means we're becoming a little more liquid. We're having our assets more able to be used because they're short-term in nature. Right? It's hard to spend a building to buy food or whatever, but it's easier to spend cash to buy food. So just remember, vertical means comparing everything against the largest number on the statement. So for a balance sheet, that's going to be the assets. And again, all you're really doing is dividing each of them by the total assets amount. On an income statement, the largest number is always going to be sales. Right? Because if you think of how it's set up, you start with sales and then you start subtracting all these things from it to get down to net income at the end. So sales will be our largest number. So it will be our 100%. And then we just divide each of these by the amount of the sales. So now we can see what's our cost of goods sold as a percentage of sales. We can see from 2015 to 2016, it actually went up a little bit as a percentage. That helps us because when we see our sales go up from 1.2 million to 1.498, we would expect to see our cost of goods sold go up, which they did. The question is, did they go up to where they're the same amount? Like they're the same percentage of sales? No, it actually went up a little bit more. That gives us a question. Why? Did our suppliers raise their prices? Does the cost of shipping stuff get more expensive? What's leading to our cost of goods sold growing at a faster rate than what the sales is growing at? Okay. And again, we just do that for each of the line items, gross profit, all the expenses, etc. We can see our net income went from 6.4% of sales to 6.1% of sales. So even though our sales grew, we're making a slightly less amount of profit per dollar of sales. Another way of looking at this number would be for every dollar of sales, I get 6.1 cents in profit. Okay. Do you guys know what this is called, the net profit margin? This percentage of your net sales as a percentage of your, I'm sorry, your net income as a percentage of sales. You guys have a guess at what Walmart's net profit margin is? It's tiny. It's like 1.2%, which means for every dollar Walmart sells, they make 1.2 cents in profit. How do they do that? They sell massive volumes. So, what's 1% of 100 billion? A billion, right? But they sell more than 100 billion. So they sell, 50 or 60, I'm sorry, like 500 or 600 billion dollars worth of stuff. So they're making profits of like $6 billion. But that's their model, is sell high volume, low profit. Smaller companies, like if you started your own company, you're not going to have the volume of a Walmart, so you're going to have a higher margin. You ever wonder why boutiques cost more than Walmart for like clothing? Well, part of it's because their cost of goods sold is higher. They're buying higher quality stuff. But another part is they have to build in enough profit margin to keep operating with only, 3 or 4 sales a day. That's what some of those high-end places do. Okay. Anyway, so that's the vertical analysis of an income statement. So again, we'll look at, whoops, should be question 2. All right, so this is Fielder Industries. They have a sales promotion campaign that includes the expenditure of an additional $40,000 for advertising. At the end of the year, Leaf Grando. That's a pretty dope name, actually. What's your name? My name's Leaf. Nice. What's your last name? Grando. All right. Because Leaf sounds like it's like from the northern countries, but like Grando sounds like it's from the southern nations. So brought together, this is like the northern water tribe and the southern water tribe creating a baby who's the next avatar. Beautiful. All right. All right. Beautiful. All right. He's got to get rid of that bald avatar. He's annoying. It's time for a new one. If you kill him in the avatar state, he won't come back. And then he won't be annoying at all. All right. That's what I want to do with Aang, especially because his name should be Ang. That's the Chinese pronunciation. I don't know. All right. So here we have sales, all those things right next to each other. So now we have to do them as a percentage. Again, we could take our calculator, right? And we could just be like 1.3 million divided by 1.3 million is 100%. 682,500. Again, putting them in negatives makes it confusing and a little bit annoying. But I'm going to just go ahead and type them up in Excel. I think it's worth taking a second to do that. If I can see things. No. I'm going to do them all as positives. So I'm not even going to include the negatives. All right. So there's all my numbers as positives for the first year for 2022, or for the newest year. So now to find this as a percentage, I'm just going to say this cell equals that divided by that. Here's my problem though. Those of you who haven't used Excel a lot, pay attention if you haven't used Excel a lot. If I then use my little tool to fill, it's not going to work because it's going to bring down my cell reference on each one. And I want to keep dividing by this top one. So if I come in here and I put dollar signs on either side of that B on the denominator, What that means is, hey, when I fill this down, keep adjusting the cell reference on the numerator, but lock in the cell reference at B14 on the denominator. That's what those dollar signs are telling Excel. So now when I come in here and I grab my little pin and pull it down, it gives me the percentages. Again, we want the percentages. So now those are my answers. So I have 100%, 52.5%, 47.5, 20, 13, 33, 14.5, 6, 20.5, 11. And then I can do the same thing for the 2021 numbers. Like the biggest hassle is just having to type them all in. And then I'll do the same thing. I'll say this top one is D14 divided by D14. But for the numerator, I'll put dollar signs on either side of the D to say, keep looking at cell D14 for the denominator, but adjust the cell reference for the others as I fill. And there we go. I've got my percentages. I'm introducing Excel to you guys this semester and having those Excel assignments because just when you get to your junior year of college, they expect you to know how to use Excel. They just think that at least basic stuff. Okay. So I'm not trying to be mean by giving you extra Excel work. And once you learn to use it, it's so much faster than a calculator for a lot of this kind of work. Whoops. Oh, now it wants them as negatives. Oh, you're annoying, Cengage. So once we've done this, again, we're in a good position to actually try to see what's happening here with this company. Their cost of goods sold as a percentage of sales is a little bit higher, which means their gross profit as a percentage of sales is a little bit lower. Their net income as a percentage of sales is quite a bit lower, right? 3.5%, or sorry, 2.5%. So again, that would give us a place to start. If we were sitting down to talk about how this business is doing, we would ask them these questions. What do you think's leading to this? It's interesting when you're doing consulting with a business and you just say like, what do you know, I've noticed that your gross profit or that your cost of goods sold has climbed up 0.5%. What do you think's causing that? And then you just shut up and let them talk. They'll tell you so much stuff about the business that's so valuable. And you'll either learn, wow, these people really know what's going on with the business, or like, oh, they really don't know. They're just out there working and selling, but as far as the numbers part of it is not comfortable for them. And you know, and you kind of go through these and say, you know, man, it looks like your operating expenses went from your selling expenses went from 16% of your profit or of your sales to 20% of your sales. What could be causing that? And they might tell you all about the new bonus structure for salespeople or something. To which you might say, well, I mean, was it worth it? Because your sales definitely went up. Do you think the trade-off's worth it? And so you have those conversations, and a lot of times they have all the answers, and you just talk with them and sort of take notes, and then you look like a genius, even though they know what's going on. They just aren't able to make a lot of sense of the numbers because they don't deal with the numbers all the time. All right. So the net income as a percent of sales has blank. It's decreased, right? Even though the net income overall, actually, the net income overall is also decreased. All the costs and expenses other than selling expenses have maintained their approximate cost as a percent of sales relationship between 2021 and 2022. Selling expenses at a percent of sales, however, have blank increased. I just mentioned that. They went from 16% up to 20%. Apparently, the new advertising campaign, what do we think? Has it been successful? The increased expense blank produced sufficient sales to maintain relative profitability. Thus, selling expenses as a percent of sales have blank. So I think the new advertising campaign has not been successful. The increased expense has not produced sufficient sales to maintain relative profitability, right? We can see our profit or net income has dropped as a percentage of sales. Thus, selling expenses as a percent of sales have increased. So this can be valuable when we're like, okay, we tried this. We did this new advertising and marketing campaign, and was it successful or not? Well, this can give us a clue that it wasn't. All right. One last concept, and it's kind of related on this vertical analysis, and that is what's called a common size statement. So if I'm thinking of investing my money in one of two retailers, and one of those retailers is Walmart, the biggest retailer in the world. Well, Amazon maybe. I think Walmart's still bigger. But and the other is Target, a very big retailer, but compared to Walmart, tiny. Like their sales, the numbers don't even, they're like an order of magnitude or maybe two orders of magnitude different. So there's a big difference between them, but I want to be able to assess which one is a better investment. A company doesn't have to be big to be a good investment. It just has to be growing, right? And so one way I can do this is using what's called a common size statement. And all a common size statement is one of these, like a vertical analysis, but then with two companies side by side instead of the same companies 2 different years side by side. Because now everything's expressed as a percentage of sales rather than as just a flat out number. Okay. So our sales for these two companies are expressed as 100%. And all you're doing is doing a vertical analysis of each company. So in the case of an income statement, dividing every line item by its sales. And then we can look at these side by side, and we can see that down at the bottom, Madison Corporation, they convert 9% of their sales into net income, and the Lincoln Company only converts 6.1% of their sales into net income. So that's a sign that Madison's doing something better, something right. So we use this sometimes when we're trying to decide between two different investments. We also use this. You can actually buy what's called industry average reports. There's companies out there that will compile this data and give you like an average or a mean um, vertical analysis for a company in your industry. And then you can compare yourself to that and be like, at what places am I better than the average company, or what places am I worse? And in those places where I'm worse, what can I do about it? Right? What improvements could I make? So that's what we use these for. And you can see with this company, Like their gross margin here, which is the gross profit as a percentage of sales, is really close. One's at 30.4, the other's at 30%. So they're both managing their cost of goods sold pretty well. In fact, Lincoln has actually got a slightly higher gross profit percentage than Madison. But then we get into the selling expenses and we can say, okay, Lincoln's definitely got a higher selling percentage, selling expenses costs, higher administrative costs. So their total operating expenses are 4% higher, leading to an operating income that's 4% lower in essence. Or the revenue is about the same. Other expenses like interest expense is fairly close. So all of this comes down to is Lincoln is weaker because of their management of operating expenses, their sales expenses and their administrative expenses. And if I was Lincoln, I could look at that and be like, okay, what am I doing that's different than these guys? And do I want to keep because 6.1% is enough profit for me? I'm okay. Or do I need to make changes? Right. Because guess what? Cutting administrative expenses usually means letting go of people working in administration or reducing the pay of people working in administration. We're going to fire a couple secretaries or fire a couple of salespeople or not compensate the salespeople as well or give bonuses to the best salespeople so that the worst ones will just get discouraged and quit, right? I mean, it means something like that. And so that's the hard part is at some point we have to convert all these numbers into what that means in real life. And that might mean firing people or laying people off. And most of the time we don't want to do that unless we have to, right? All right. Last question on the guided. So here we have revenue and expense data for the current calendar year for the Tannehill Company and then for the electronics industry as a whole. So they were able to buy these these averages for the industry. So Tannehill's data are expressed in dollars, and the electronics industry is expressed in percentages. So I get what they're asking us to do is just convert Tannehill's information into these percentages. So again, I'm just going to take these amounts from Tannehill, start with 4 million, which is their sales. And then we're going to just express all those as a percentage of the top line or the sales amount. So I'm going to say this equals numerator is the sales amount divided by the denominator, which is the sales amount. And then I'm going to lock in my cell for the denominator. So now I'll just say, all right, my sales is 100%, which is what we'd expect. Cost of goods sold, gross profit, 47%, selling expenses. again. So use a check here just to make sure. Once we have all that in, we can sort of look at it and make comparisons. So our cost of goods sold is 7% less than the industry as a whole, which is pretty good. It means we're either getting a cheaper supplier or we're getting some sort of a discount for buying in bulk, or we're somehow savings on, again, it'd be a question worth asking. Why is ours cheaper than the industry average? And how do we keep that going? Is it just that we have good relationships with our suppliers? Is it that we take the discount by paying early? What's giving us 7% less cost of goods sold on average, which leads to us having a 7% greater gross profit. We can see our selling and administrative expenses are actually a little bit more than the industry as a whole. Right, there's our 24%, ours are 27. So our total operating expenses are 4% of our sales as opposed to the industry average of 2. So there's an area where we're not doing good as the industry as an average. Again, we can ask ourselves, do we want to make a change, or are we willing to eat that cost because our employees are happy or whatever, right? That's just, and then other revenues the same, other expenses are the same. Our income before tax expense, we're making 5%. They're only making 3%. Income tax expenses are the same. And our net income is 2% greater. So even though our operating costs are a little higher, those savings on cost of goods sold lead to us having a little bit higher net income. So overall, we're doing better than the industry. So the company's managing the cost of manufacturing product blank than the industry, so worse, and has slightly higher selling and administrative expenses relative to the industry. Let's see. Cost of oh wait, this isn't cost of. Okay, so they must be a manufacturer. So their cost of goods sold is slightly better and slightly higher selling and administrative expenses. The combined impact causes net income as a percent of sales to be blank, higher or better than the industry average. All right. So that does it for the first part of chapter 14. Horizontal analysis, comparing the same company year over year. Vertical analysis, comparing everything against that line item of sales on an income statement or total assets on a balance sheet. And then common size statement, which is very similar. It's just looking, instead of comparing yourself against yourself, you're comparing yourself against other companies in your industry. All right. All right. That's enough for one day.